Why am I so sure that the stock market's going to crash, that the S&P will go down 25 to 50%? Why am I so sure? Because of artificial intelligence. I didn't rely on my mind. I went to artificial intelligence and I just asked the right questions. Evaluate where we are. Evaluate where we've been. Look at what happened in the past. Tell me what's going to happen in the future. Why wouldn't anybody do that? That's what I did. And then when I did beyond that was I said, I'm not going to present this to my audience. I'm not going to present this to the world. I'm going to let artificial intelligence tell the world what happened, what's going to happen, and why it's going to happen. That's what I'm going to do in this video. It's not me. It's me and my artificial intelligence that is going to show you exactly why the S&P is going down 25 to 50%. Then we'll talk, what do you do about it?
Best of Us Investors presents Kerry Griegmeyer.
An inverted yield curve occurs when short-term interest rates are higher than long-term rates. This phenomenon is often considered a signal of potential economic distress. Historically, an inverted yield curve has been associated with economic recessions, and its relationship with the performance of the stock market is significant. Banks and other financial institutions typically earn profits by borrowing money at lower short-term rates and lending it out at higher long-term rates. An inverted yield curve can squeeze their profit margins and hinder their ability to lend, which can negatively impact the overall economy. Historically, an inverted yield curve has been followed by stock market corrections or bear markets. Investors may interpret the inversion as a signal that economic conditions are weakening, leading to a decrease in corporate profits and a subsequent decline in stock prices. An example of this can be seen in the subprime crisis of 2009. The subprime crisis was triggered by a collapse in the housing market, particularly in the subprime mortgage sector. As the yield curve inverted, it put pressure on financial institutions that relied heavily on borrowing short-term at lower rates and lending long-term at higher rates. This squeeze on profit margins contributed to a more cautious lending environment. Financial institutions bundled these subprime mortgages into complex financial instruments, such as mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, which were then sold to investors. The risk associated with these securities was often underestimated or not well understood. As the subprime mortgage market deteriorated and homeowners started defaulting on their mortgages, the value of mortgage-backed securities and related financial instruments plummeted. This triggered a broader financial crisis as institutions faced substantial losses and struggled to maintain liquidity. The financial crisis had significant spillover effects, leading to a global recession. Stock markets worldwide experienced sharp declines, and the real economy was severely impacted by the credit crunch and financial instability. A similar scenario is developing in the commercial loan market around the world. Growing vacancy rates in commercial buildings, particularly in major cities, can be indicative of challenges in the commercial real estate market. Economic factors, changes in work patterns, such as increased remote work, and shifts in demand for office space can contribute to these challenges. The stress on the commercial loan market can affect financial institutions, especially those with exposure to commercial real estate loans. If defaults increase, it could lead to losses for lenders and potentially impact their ability to extend credit. This is very similar to what happened in 2009. If economic concerns related to commercial real estate and the commercial loan market intensify, it could contribute to a more cautious investor sentiment. Investors may reevaluate their portfolios, potentially leading to a correction in the stock market. Add to this the recent liquidation order of Evergrande by the Chinese government. As concerns about the Chinese real estate market intensify, investors may seek safer assets, such as government bonds. This increased demand for long-term bonds could contribute to further flattening or inversion of the yield curve. China is a major player in the global economy, and a real estate crisis could have spillover effects on international markets. A slowdown in China's economic growth could lead to decreased demand for commodities, affecting global trade and economic activity. This broader economic impact could influence central bank policies and interest rate expectations. Central banks, including the People's Bank of China, may implement monetary policy measures to address the real estate crisis and its potential impact on the broader economy. The fact that Japan has replaced China as the largest purchaser of U.S. treasuries can reflect a shift in global investor behavior. If investors in China are facing financial challenges or uncertainties due to the real estate crisis, they may reduce their exposure to U.S. assets. This shift in demand for U.S. treasuries can affect interest rates and impact the broader financial markets. Predicting the stock market is inherently challenging, and there are multiple factors at play. The combination of an inverted yield curve, potential devaluation of commercial real estate, the Chinese real estate market crisis, geopolitical tensions such as the Russia-Ukraine war and the Israel-Hamas conflict, can contribute to increased market uncertainty. During times of uncertainty, investors may seek safe haven assets, such as government bonds and gold. This flight to safety can lead to shifts in capital away from riskier assets, including stocks. Significant uncertainty or unexpected events can trigger sell-offs and corrections in the stock market. Investors may sell their holdings in response to perceived risks or uncertainties, leading to a decline in stock prices. Different sectors of the economy may be affected differently by uncertainty. For example, economically sensitive sectors, like technology or consumer discretionary, may experience more significant volatility compared to defensive sectors, such as utilities or healthcare. Uncertainty can lead to a delay in investment decisions by businesses and spending decisions by consumers. Companies may hold off on capital expenditures, and individuals may postpone major purchases, contributing to economic slowdowns. Governments and central banks often respond to heightened uncertainty by implementing policy measures. For example, central banks may adjust interest rates or introduce stimulus packages to stabilize the economy and financial markets. While uncertainty can lead to short-term market disruptions, it can also create long-term investment opportunities. Market downturns may present buying opportunities for investors with a long-term horizon, as stocks may become undervalued. Kerry, this was a daunting assignment. I sense your concern as well as you believe that you may have come upon an investment opportunity. Please call on me for any more assistance that I can offer you and your tribe.
That was my avatar, Eric. I asked him to go dig it up, research it for me, and then make his presentation. That's what the world's all about. And I'm here to tell you that the market's going down. It's been proven. It's there for you to look at. Come to my website. I'll show you the charts. I'll show you the inverted yield curve. I'll show you the movement in interest rates, and I'll show you what happened in 2009 and 2000 and how the market crashed in both cases. And it's exactly set up to do it again. Now the question comes is, how do you avoid it? Do you go to cash? Do you go to gold? Do you go to bonds? That's the next step. You can avoid it. All you got to do is go to cash. But how do you profit on it? That's what I'm working on now. That's what Eric and I are working on now. And I'm going to share it with my tribe members. That is, everybody who is a part of our Platinum program. I'll share with you what I'm buying and how I'm going to profit off of this 25 to 50% drop. It's up to you. Get in the game, or sit on the sidelines, or just get run over by the train. It's up to you.